Welcome back. I don't waste your time. Let's get straight into it. If you guys follow me on Twitter, you would notice in my bio, I have in fact initiated a new position in a company that has done very poorly over the past year, really. The stock's done horribly. It is in fact Starbucks, and I'm sure many of you are familiar with Starbucks, but in today's video, I'm going to be covering why I think Starbucks presents itself as an asymmetric bet to really outperform over the next decade or so. And we're going to go over everything. We're going to go over what I think about the moat and some valuation work, the growth that I see for the company, the maturity risks, and all that type of stuff. For starters, I do want to go over this video by this gentleman, Polymatter here, because everyone understands what Starbucks does at face value, but what's more important about Starbucks is in fact the digital offering that it has, the Starbucks app, the loyalty program, all that type of stuff. And I don't want to sit here and try to do a shittier version of his explanation, so I'm just going to let you guys listen to his explanation of things.
One of the less high-profile changes was an increasing focus on technology. This began with the introduction of the Starbucks card. For the uninitiated, the way it works now in 2021 is this. Instead of paying with cash or credit card, you can also add money to your Starbucks account. Then you can pay with the app on your phone, giving you twice the number of stars, which let you redeem free drinks. While this may not sound all that revolutionary, Starbucks is the most popular restaurant rewards app, allowing it to do what others can't. Because of its size and customer loyalty, people are not afraid to keep decent chunks of their money in their Starbucks account, knowing they'll use it eventually. 41% of US and Canadian users pay with their Starbucks card. At the end of 2019, users held a collective $1.5 billion in balances. To put this in perspective, 85% of all US banks have less than $1 billion in total assets. Customers will, of course, eventually exchange this money for coffee, but in the meantime, unknowingly provide Starbucks with a $1.5 billion loan at 0% interest. That's money Starbucks could simply invest in the market, earning free money from the generosity of its users, or spend on building more stores. Actually, it's even better than that. About 10% of this money will be forgotten or lost and never used, known in the industry as breakage.
So, with that being said, as you can see, Starbucks benefits from I think as it stands today, roughly about $3 billion is just sitting in accounts. And what that does for Starbucks is they could reinvest all this money into the business, make new stores, whatever the case is, and earn a return on that before they even provide the service to the customers in the form of course, the coffee. So what's important to note about this is this concept of float. They earn money before they even have to provide the service, which lets them reinvest back into the business before they even have to pay, not really pay, but earn that money, right? So they're reinvesting into the business with unearned revenues. With that being said, I have the Morningstar report pulled up here. I think they provide very excellent analysis on companies. So I've gone through already and I've highlighted some key points that I want to cover. First things first, of course, everyone's probably wondering, okay, great, they have this app, but Starbucks is a very undifferentiated product, right? It doesn't really matter at the end of the day. You're buying coffee from Starbucks, or if you're going to McDonald's, if you're going to Dunkin' Donuts, whatever the case is, right? Coffee's coffee. It's a very commoditized product. With that being said, Morningstar thinks differently. So they go on to actually address these issues. They say, low barriers to entry and minimal switching costs render the restaurant industry very competitive, making it difficult for most operators to develop an economic moat. In our view, firms that are able to do so generally lean into brand intangible asset or a scale-driven cost advantage, with those sources often arising in tandem. So if you missed it, they said brand intangible assets. What they mean by that is, sure, they do provide a commoditized product. Doesn't ultimately matter where you're getting your drinks from, but what's more important is the experience that you have with this brand, right? So when you go into a Starbucks store, maybe the smell of the Arabica beans as soon as you walk in, or maybe the colors that are provided in the store. So oftentimes, Starbucks, for example, has much more earthy colors. They got dark browns and dark greens, and it's a much more calm and it's a much calmer experience and much different from, for example, McDonald's, right? McDonald's is like a very yellow, bright, red, right, in your face type of experience, and Starbucks has kind of positioned itself to be, as they say, the third place between work and home, right? So that's the branding that comes into this, right? Where people might start to prefer Starbucks and the whole Starbucks experience of going to the store and all that type of stuff. They also say that scale-driven cost advantage, right? And this is the number one thing that I look for in any of my investments ever, especially even if we go back to my portfolio here. Amazon, you would notice, is my biggest position, 35%. And Amazon benefits from massive amounts of cost advantage, driven primarily by their scale economies. Starbucks is much in the same, right? Starbucks is massive store count of, I think, almost 40,000 stores gives them the advantage when it comes to bargaining with suppliers, right? So they'll often say to suppliers, hey, we're probably your number one buyer of Arabica beans. Why don't you give us a discount for us to continue being your customer and being a loyal customer at that, right? Or when it comes down to even reinvesting into the business, they have this massive scale where, for example, if they were to they were to implement some new technology or some new equipment, because of the massive scale, as a percentage basis, that new implementation of new technology goes across several more stores compared to, say, I don't know, Dunkin' Donuts, which is a much smaller competitor. What I mean to say is $1 billion investment in some new technology goes much farther than, for example, if Dunkin' were to do the same investment on a much smaller store count. To summarize my thoughts there. Scrolling down, we have here, I highlighted, with brand strength, evidenced by pricing power, attractive unit level economics, successful international replication, and strong result in retail channel underpinning a durable brand intangible asset. So they kind of just said what we mentioned here. They benefit from pricing power and attractive unit level economics due to their scale, right? Over here, Morningstar says, moreover, though we view it as a secondary moat source, we also believe that Starbucks benefits from a durable cost advantage with its global scale, allowing it to procure commoditized products, food, and paper items at favorable prices. Again, what I mentioned earlier, right? They get a lot of bargaining power when it comes down to talking with suppliers. The firm's scale allows it to leverage technology spending across a larger store base, generating efficiency improvement and cost savings through automated inventory management, scheduling, and a robust omni-channel ordering platform. So again, what I mentioned just a second ago, where the investments they make into the business goes much farther than, for example, Dunkin' Donuts or whatever other competitor, because they're able to, I guess this is the incorrect word to use, but amortize that across a much larger store count. The firm can continue to earn positive economic returns for the next 20 years. That's incredible. So they believe that they could have growth out 20 years from now. A view embodied by our 10-year forecast of return on invested capital of 30%, healthily outstripping our weighted average cost of capital of 8.5% during that period. So they're saying there's a spread of roughly, 25-ish percent, about 25-ish percent between their cost of capital and the return that they're able to earn on the invested capital that they put back into the business. Scrolling down here, so here they talk about the competition and how Starbucks stands against them, right? So they say historically, Starbucks has managed its positioning to avoid finding itself caught between discount competitors like Dunkin' and McDonald's on the low end and independent shops on the high end of the market. So Starbucks is kind of in that middle area where they're not seen as a cheap option, but at the same time, they're not like a luxurious option. They're more premium. I think premium is the appropriate word to use here. And over here, they talk about the average ticket price, which ticket, I believe, is just the average amount that the average consumer spends at a Starbucks or McDonald's or whatever. So they say a global average ticket of roughly $8 in 2022, based on Morningstar estimates, outpaced peers like Dunkin' at $4 and McDonald's at $5. Luckin Coffee, which I've never heard of, at $2, corroborating our thesis. So they're saying that this pricing power and the intangible asset of their brand plays into the aforementioned unit level economics, which is that they're able to sell much more on average than their competitors, right? And they're able to sell at higher ticket prices. Scrolling down, I believe, here they say, finally, while lower marketing costs as a percentage of sales, averaging 1%, relative to McDonald's 4% marketing royalty rate and Dunkin's 5%. So here they're talking about how, sure, they got the brand and everything, but how much are they spending on marketing to maintain this brand? You would be surprised to find out that they're actually spending less than competitors. So McDonald's is spending roughly 4%, Dunkin' 5%. Meanwhile, Starbucks is only sitting at 1% of revenues as a percentage of marketing spend. And this, I guess, kind of speaks to the fact that Starbucks has a much stronger brand, therefore they don't need to spend as much to upkeep and maintain that brand and possibly grow that brand, because they already are sitting on such a strong brand. This could be construed as a cost advantage. We believe that it more accurately reflects brand strength, as Starbucks has been able to generate buzz and sales volume despite a tighter marketing budget. So they're kind of saying what I'm saying here as well. Because they have such a strong brand, they could have a tighter marketing spend and reinvest that into actual store count and making the product better. And I think I have, yeah, one more highlighted thing here. The firm believes, this is about the app, this is very important stuff. The firm believes that the loyalty program members spend as much as 2 to 3 times that of non-loyalty program participants, and storing ordering data on a proprietary platform affords the firm an invaluable database of popular item pairings, promotion efficacy, so on and so forth. So what they're saying here is the average consumer that is using the Starbucks app not only provides them with invaluable data, but on top of that, they actually on average spend 2 to 3 times more than the people that aren't on the app. This kind of speaks to the relationship that Starbucks is able to build with their consumers, which I think also is very key to the whole thesis with Starbucks, right? So they're able to build these relationships with their consumers, and this speaks to their moat, right? Moving on, they say customer base in the neighborhood of 75 million. So actually, we'll go over to the slide deck in a second here. But they have it at roughly 55-ish million, but that is only US and China. You guys will see in a second here. But that's incredible. 75 million members in their app is truly incredible stuff, which implies a penetration of roughly 4%. So they're saying of the people who shop at Starbucks, only about 40% of them is are actually on the app. That should provide a natural secular tailwind for same-store sales growth, which again, we'll go over that in a second as well. But as more people come onto the app, they'll start spending 2 to 3 times more, which will drive up that same-store sales figure. And quite honestly, I would only be worried about maturity with this company as this figure right here starts to inch closer and closer to the maybe like the 70, 80, 90% range, right? If everybody's on the app, then that doesn't leave much more room for same-store sales growth. I believe, yeah, okay. So here they talk about the forecasts that they have, and I actually in an aforementioned video I was talking about how I think Starbucks is way too mature, right? They're roughly at 38,000 stores, and I was saying that McDonald's at 44,000, but obviously that's food and everything like that. I think McDonald's has a higher total addressable market than Starbucks. Starbucks is coming up to maturity pretty soon. I would be wrong. So Starbucks themselves in the 2020 Investor Day, they forecasted for 55,000 stores by the end of the decade. Now that puts them above Subway, that puts them above McDonald's, that puts them above any other retailer or QSR that comes to mind. And 55,000 stores, again, we'll go down in a second here. They're estimating much slower growth rates, Morningstar themselves, but Starbucks has guided for incredible growth for the decade to come, right? Now, you guys are probably all hearing this and you're like, okay, Arya, amazing, amazing stuff. They got a very strong brand. They got cost advantage. They got what seems like incredible moat, higher ticket prices, and they still have a total addressable market that's growing and hasn't been penetrated through the app, right? So lots of secular tailwinds behind them, and they have a bunch of different stuff that they could grow into. What are the risks with this business? This isn't MasterCard and Visa, where it's just roses and daisies all around, right? There is a lot of risks to Starbucks. For starters, they're saying that they assign a medium uncertainty rating. While the firm sells categorically high-priced products, its position as an affordable luxury, that's very important. Starbucks' position as an affordable luxury and a relatively affluent clientele seems to insulate it from the worst of cyclical pressures, as evidenced by consistently positive transaction trends in fiscal 23 and into fiscal 24. Despite meaningful price increases and industry-wide pressure, other key uncertainties include input costs, inflation, and operational risks. So what they said here is, sure, Starbucks at the end of the day, let's face it, is a consumer discretionary product. But what they're saying is, because it's positioned as a more luxurious premium product, that often invites people who have discretionary income to spend, right? And that kind of insulates it from the cyclicality of boom and bust as the economy slows down and so on and so forth, right? So they're saying it's kind of insulated from the natural cyclicality that a non-discretionary company would invite. And they also make mention that the real uncertainties to the business would be input costs. If you didn't know, coffee bean prices have absolutely skyrocketed in the past couple of weeks to, I think, around a year. So stuff like that is the bigger risk. How much it costs for them to actually create coffees and all that type of stuff. But I would imagine that they just pass these expenses on to the consumer, and the consumer gladly pays that. Additionally, they make mention of wage inflation. So this is a thing, if you didn't know, I think California raised their minimum wage to roughly like $20. Yeah, they make mention right here. Eyes turn to California, where legislators mandated a $20 minimum wage in the restaurant space for 2024, perhaps a harbinger of similar changes in more politically liberal states like Oregon and Illinois. So they say stuff like this could continue to happen, where they increase minimum wage, but as we've seen with Chipotle, for example, or McDonald's, these companies, they just pass that right on to the consumer, not any other problem, right? At the bottom here, I think this is the final highlighted item I have here. To this effect, they talk about capital allocation and growth. They say, to this effect, we expect average annual free cash flow to the firm to average 11% of sales. So they're saying 11% of revenue turns into free cash flow over the next 5 years, affording Starbucks a substantial degree of investment flexibility, with the firm able to deploy capital towards operational investments, new unit openings, and employee wages and benefits. So they're just speaking to, we expect pretty fast growth out of Starbucks, and this allows them to consistently reinvest back into the business and make, I think it was 34% return on invested capital. So truly amazing stuff. To summarize this entire report, we have a very wide moat business that is extremely free cash flow generative, and it's able to invest back into the business, have very high invested capital figures, right? Moving on, I'm sure I haven't bored, I'm hoping I haven't bored you guys to death by now, but this is the Q4 2023 investor presentation. What's important to note off this first slide here is the comp figures. So in Morningstar earlier, we looked at it. They were estimating much lower same-store sales growth, or comparable store same-store sales growth, or whatever, around the 5% mark. Starbucks is currently sitting at about 8%, right, in the most recent year. And by the way, if you don't know what same-store sales is, I should probably mention this earlier, but what it basically looks as it is, of the store count that we currently have, how much additional revenue has that store count generated, right? So not new stores opening and creating new revenue. Of the store count that we already have, how much do those stores make additionally per year, which is 8%. Incredibly healthy figure, right? Scrolling down a little bit more, they have about 38,000 stores with operating margins of 18%, and their digital offering, of course, the app is 33 million in the US and 21 million in China on a 90-day rolling period. So during Q4, they had that many people use it in the US and that many people in China. And of course, earlier in Morningstar, we saw that's about 75 million globally total that use the Starbucks app. This is the more important slide. So I really do want to draw your attention to a couple key figures here. They estimate that moving forward, I believe, yeah, guidance is down here, right? So again, this is the comparable same-store sales figures and all that type of stuff. But they say guidance for 2024, they estimate that comparable growth is going to be around 5 to 7% globally. So a slight slowdown from the 8% in the most recent year. And they see that global revenues will expand roughly on the low end of 10 to 12%, right? So to take these numbers at face value, let's just say they have 7% comparable growth and they have about 10 to 11% revenue growth total. That means that 4% of that is derived from new store openings, right? And then over here, they say operating margins, they expect it to continue expanding, capital expenditures of roughly $3 billion, and they expect earnings per share to grow between the 50 to 20% mark. Very healthy stuff. Another thing I'd like to draw your attention to is China is an incredible growth vector for Starbucks on a going forward basis. They estimate roughly 13% store count growth in China specifically, 7% globally, 4% in the US. So US seems to be very mature, China not so much. Massive growth vector for Starbucks. Moving on, I'd like to draw your attention to this gentleman here. I think you could almost see his, yeah, there we go. So Natan Investing, great follow on Twitter. I highly recommend going and checking out his page. But he just does some back of the napkin math. This was posted, I believe, today. Yeah, it was posted today. But he does some back of the napkin math, talking about the current revenue, what he expects revenue CAGR, which, might I remind you, Starbucks themselves have guided for higher revenue growth than what he's expecting here, and so has Morningstar. So Morningstar and Starbucks themselves have higher revenue CAGRs than this, 8% here. This is incredibly conservative. He estimated a profit margin of 13%. That's about in line with the numbers that I came up with, and a terminal PE ratio of roughly 20. right? Again, seems fair. So that would actually be multiple compression. I think Starbucks is a 22, 23-ish PE as it stands currently. So to summarize, he's saying if Starbucks were to conservatively grow their revenue and about maintain profit margins and actually have their multiple compress, he lands at roughly 11.7% expected return from the stock over the next 4 years till 2028. And then he does assume buyback plus dividend yield of 4%. So that again also lines up with my estimates of roughly a 2.5% dividend yield, and then a 1.5% buyback yield. So these numbers seem more than fair to me, and if anything, a little bit conservative. And despite that, he's still getting market-beating returns out of Starbucks over the next 4 years. Moving on, I would like to go to, if you didn't know, I have this free cash flow calculator. So I'm sure you guys are aware of the PEG ratio, where it takes the current PE of the company divided by how much it's growing in EPS. I basically did the same thing, but instead of PE and the growth rate of EPS, I take into consideration the free cash flow growth rate of a company and the price to free cash flow of that company. So I'm literally doing exactly what the PEG ratio does, except I use cash flows because as investors, we own the cash flows of the company. As you can see, Starbucks on a forward basis is roughly trading at 24 times forward price to free cash flow, and they're expected to grow that free cash flow by about 13%. Might I remind you that they're doing revenue figures of around 10% as it stands currently. And on top of that, they're expecting massive operational leverage when it comes down to their business, which means that their free cash flow margins is expected to grow over time. And if you're wondering how I came up with that growth rate, I went and I looked at analyst estimates and I played around with this. So I had 2023 here, 2025, 6, 7, but there's less analysts as it goes on. But I played with the numbers. One of the lowest numbers I came out with was 13.5%, right? So this is actually one of the lowest numbers, and my assumptions here are quite conservative. Another thing before you guys mention it, why is the SBC at 0%? It's because they actually subtract out stock-based compensation as an operating activity as opposed to investing activity. So the numbers that I was able to get from the statement of cash flows is it's already been adjusted for cash flows. Huge green flag, by the way. But anyways, to sum up everything, after we take all that, so we take the price of free cash flow and divide it by the growth rate, you land at roughly a 1.76 times growth rate multiple. Now, this is significantly cheaper than stocks that I've been buying the past couple of weeks to a month. I've been buying Amazon, I've been buying Google, SCHG, Salesforce recently. I've been buying significant stake in Salesforce the past couple of weeks especially. But looking at Starbucks' numbers, they are significantly cheaper than all these other companies that I've been buying. Of course, Ulta and Evo that are in my portfolio, but I assessed much higher risks with those two businesses, hence why I'm kind of handicapping the percent allocation that I'm putting towards those companies. But as it stands currently, Starbucks seems to be the best valued company in my investable universe, and hence why I initiated a pretty significant position in Starbucks. So to recap literally everything that's been said in this video, we have a very wide moat company that benefits from cost advantage driven by their scale economies and their incredible brand. On top of that, this company is growing incredibly fast with a very healthy return on invested capital. And on top of that, they have a very healthy comparable same-store sales growth. And all of this while they're expanding margins and their valuation is incredibly low. That's why I've been buying it. So with that being said, I hope I've assisted you with just some general information on Starbucks stock and possibly taken into consideration with your research. As always, this is not investment advice. Everything I said in this video should be taken for entertainment purposes only. With that being said, thank you for watching. Have a great day.